People are
Right.
using the term everything bubble right now. Can you explain why some people are calling this, what we're seeing right now in the market, an everything bubble?
Sure. Yeah. So the everything bubble term kind of came to fruition in early 2022 with a famous investor named Jeremy Grantham. And he said that we are in an everything bubble that is about to pop due to rising interest rates. And the logic behind that is when 2008 hit, it was financial Armageddon. And in order to save us from falling off a cliff, literally the entire economy, global economy. It was bad, but it could have been much worse. The Federal Reserve pumped enormous globs of stimulus into the economy. That
Hmm.
included buying a bunch of treasuries, that included buying a bunch of mortgage backed securities, that included cutting interest rates to zero. And those policies, known as ZIRP, Zero Interest Rate Policy, ZIRP, were supposed to be kind of this like temporary medicine for the great financial crisis. But they stuck around. Those policies stuck around in 2010, 2011, 2012, 2013, so on and so forth, because the economy never really got its groove back. It forever remained this slow growth, low inflation economy. So there were no risks of overheating and therefore no need to raise interest rates or to remove ZIRP. So we stayed in this exceptionally accommodative monetary policy backdrop for 6 years,
Hmm.
7 years, 8 years into 2016.
Hmm.
Then the Fed started hiking rates, and they hiked very slowly between 2016 to 2018. Didn't hike that high, up to a little bit over 2%. And the markets freaked out a little bit. They're like, hey, don't take away my crack pipe, because that's what all this liquidity is. It's a
Yeah.
crack pipe for the markets because
Hmm.
everything gets based on all this liquidity. So the markets freaked out when the Fed, tried to take away the crack pipe, and the markets tanked, and the Fed gave the crack pipe right back, like a little addict.
Hmm.
And then we came into 2020, and all of a sudden COVID hit,
Hmm.
which could have been a economy-ending phenomenon, and we threw more stimulus into the fire, right?
Hmm.
So we now have had two episodes over the past 15 years of throwing enormous stimulus into the fire without pulling any out.
Okay.
That's resulted in an economy that's getting pretty hot. That's
Hmm.
resulted in an economy with very strong inflation that needs higher rates. And so now, for the first time in 15 years, 14 years, the Federal Reserve is going to significantly and seriously tighten monetary policy.
Hmm.
Why does that contribute to the everything bubble?
Hmm.
Well, liquidity, excess liquidity for 14 years built the everything bubble.
Hmm.
Excess liquidity is what allowed home prices to surge to record highs and grow at record rates.
Hmm.
Excess liquidity is what allowed the stock market to balloon to, historically we've traded at around 16 times, 17 times, sometimes 14, 15, 13 times forward earnings.
Hmm.
Over the past 5 years or so, we've been trending in the 19, 20, 21 times range. So excess liquidity has allowed stock market valuations to balloon. Excess liquidity has allowed startups and early stage companies to raise enormous amounts of capital at dirt cheap costs. It has fueled, excess liquidity has fueled enormous M&A activity that a lot of times happens at premium valuations, because if they're funded by debt, the interest to pay off those acquisitions is very small. So excess liquidity has essentially created a bubble across all financial activities.
Hmm.
And when I say that, I don't say that in a sense that that's a bad thing. The existence of a bubble doesn't mean the bubble needs to pop. Bubbles can go on for decades and decades and decades. It can go on for a very, very, very long time. And sometimes bubbles can become the norm. So the very existence of these bubbles propped up by excess liquidity across the US economy, across the global economy, is not a bad thing. Like I said, it's been a bubble for a long time. The bad thing is that now the Fed is being forced to pop the bubble because the Fed has a dual objective: and full employment and price stability. Right now, they have full employment met. They do not have a handle on price stability at all. So they need to hike rates aggressively to get price stability back in under their control. That aggressive hiking is what could cause all these individual bubbles to pop one by one, like dominoes, or all at once. And if that happens, then it's a bad situation.
Yeah.
It is. It's worse than '08. It's worse than 2020. It's worse than 2000, 2001. It's worse than anything we've seen in our lifetimes. So the very existence of that threat is what's driving stocks lower, is what's causing this rolling bear market to occur. However, our thesis is that the everything bubble is not going to pop, and that the Fed is not going to hike rates to a point where they will pop all of these different bubbles. So we think that there is the existence of a major threat, but we are going to avert that threat. However, in the meantime, between now and when we actually avert it, the fear of that massive threat coming to life, becoming real, actually crashing the U.S. economy is enough to create tremendous pressure on stocks and enough to have this rolling bear market just kind of go through everything right now. So that's what's going on in the markets right now, and that's why you're seeing really, really sloppy, ugly, and painful trading action. It's by far and away the toughest market since 2008.
So what you're saying, it's not even the bubble, it's the fear of the bubble that's causing a lot of what we're seeing right now in the market. Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description, or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.